Take a listen to this clip from CNBC that says investors should stay patient in the near term with double-digit upside in 2025. This is interesting. His firm expects between 6,600 and 7,700 next year. That high end is well above consensus estimates, although this guy is kind of negative in the near term. I will explain what you can expect to happen this week in markets, any and all economic data, some of the problem points of this week, and some of the positive points of this week. And of course, I will share my expectation of what I'm expecting. So let's get into it with this clip. First things first.
Yeah. What does today look like, and what does it tell you?
I think today what we're getting here is just part of the pullback that we saw after JP pulled the eggnog on the 18th. We had a distribution day on that day. That means we had 90% down volume, 90% stocks were down on that day as well. So it's distribution. I mean, there's resistance now forming within the market. I think this is follow through on that.
But if JP set the tone and this is follow through on that, does it mean more of this ahead?
I think so. I think into January. See, the conventional wisdom was we were going to get a degrossing event in January. I think what happened on the 18th was we're pulling that forward. Right, so we should continue to see the market pull back. I don't think we'll get as low as the 200-day moving average. My guess is, we'll find support somewhere around 5,800 and then start to work our way back up.
But why are you more optimistic in the longer term? Expecting as much as double digit? We're having two now back-to-back years with more than 20% gains.
Yeah. So I think we could do that. Reason being is that even though interest rates are going up, financial conditions haven't tightened yet, right? And that to me is like the main bullish case you can make from a technical perspective. I'm primarily an equity guy, but I listen to the fixed income market so closely. And until financial conditions tighten, either credit spreads or Moody spreads, triple
you don't
Bs.
See that, even with this move up. And
I don't see it yet.
Because we are seeing higher yields and a stronger dollar, both of which I think you expect to continue.
I do think yields will go up over time. I think yields are in a multi-year uptrend, so I think they're going to go up for long periods of time. And I do think that stocks and interest rates can get along. I think cats and dogs can get along in this scenario, like they did in the 50s and the 60s. If you actually were to see a chart of the S&P during that time frame, they both went up concurrently. I think we're going to that period.
What, because the economy is just so good?
Yeah, it was more of an inflationary situation. We just went through like a decade of deflation. Now we're reflating right now. So I think we can continue to see that, but what's happening is that equities are going through a bit of a hissy fit, a bit of a tantrum every now and then. So while I think interest rates will get to maybe like 5.25 to 5.5 next year, I don't think it'll be enough.
5.5?
Yeah, could get that way. That's what the charts imply.
People are wondering if they should be freaking out now about 4.6.
Yeah, I know. Well, they have to get used to it.
Huh. What about the NASDAQ? Does that mean NASDAQ continues outperformance?
I think NASDAQ has the ability to be a market performer. And I think what's going to happen next year is we're going to see a rotation out of these momentum winners. So if 24 was about breadth expanding, 25 is going to be about whether or not that momentum gravy train is going to continue or not. So but what I mean by momentum is like those outperformers as a factor, the momentum as a factor, whereas should we be buying laggards, like the ones that are down and out of 52-week lows? The answer is no. I think what's going to happen is we're going to rely less on tech, we're going to rely less on financials, we're going to rely less on industrials, but we're going to start looking a little bit more at the cyclical laggards, like in energy, materials, and parts of discretionary.
Where does that put small caps? Because that's been a big question lately. Right. Looks like they're going to close the year up more than 10%, but still underperforming when so many people were optimistic this was the time.
Yeah, and it was right after the election was a massive breakout for small caps. You got it, petered out, and now you're down quite a bit. You retraced more of the election rally.
Tough month, December.
Very tough. We're very close to the 200-day moving average. I'm going to give it breathing room. So long as it stays above the 200-day moving average, I'm going to give small caps the benefit of the doubt. And the back test that I have done does show that the market should continue to broaden out next year. So what do I mean by that? It means that breadth should improve. So this is a pullback that I think the market is using, or market participants will be using as an opportunity to get stocks that were overbought after the election at a better price right now.
So you don't see the run up in the mega cap stocks and the outperformance as tied to the higher interest rates?
Not necessarily. How I would put it is this way. At some point, the euphoria that was created after the election will be wringed out. And I think that we're in that process right now. At that point, then the average stock will start to work its way higher. And that's when things will get back into gear again with interest rates and the average stock. Right now, I think we're just having a bit of a shakeout, year-end, profit-taking, whatever you want to call it. But I think that's ultimately how we work our way higher. a sentiment extreme, a bearish sentiment extreme, and those parts of the market should create an oversold condition, and then the market will pull itself.
And how do you get to 5.5% on the 10-year?
How do I get to 5.5%?
That's so out of consensus.
Well, there's different types of measuring techniques we do as technicians. One of it would be if you just would assume that the last couple months were just that pullback in interest rates was a consolidation in rates, you're just going to resolve it higher. It's called a measured move technique that we have, and it's just based purely off of the chart, to be quite frank.
But you think it's going to be cool for stocks?
I think it'll be okay,
right.
But the trick is the volatility of it. That vol has to be low, and that'll be all right.
Well, John, it's good to have you here in town. John Kolovis at Post 9.
That was definitely an interesting take on our markets. Now, I agree with a lot of what he said in the sense of markets could go lower from here, but I don't think it's going to be an even sinking of the ship, okay? I've talked about this before here on this channel, and I will say it again because I think it's so important. The RSP, the equal weight S&P, has gotten destroyed, okay? The equal weight S&P fell 8% at the lowest point. It's still down about 6%. The S&P fell 4% at the lowest point, and it's still down about 2% or so, about 2.3% or so. So there's a massive gap differential between what's happened in the RSP, the equal weight S&P, and the headline RSP. I think a lot of the spread here has to do with tactical kind of positioning into year end, like a lot of tax loss harvesting happening in the RSP and big tech holding up a little bit better. And I think we started to see a little bit of that flip-flop on Friday with big tech starting to finally underperform. And I think really as we get into January, this is going to become a little bit more obvious where maybe the rest of the markets can start to do a little bit better, but big tech kind of lags behind. Everyone, well, not everyone, about 75% of hedge fund managers are expecting big tech will underperform next year. Okay. That's pretty powerful. And I think that's because clearly fundamentals are supposed to get a little bit better with other areas of our market. So tech's not going to be the only, place in town that actually works. Now, we did find support at the 50-day moving average on Friday for the S&P. If we do have a rough ending to 2024 or a rough first start to 2025, that's going to be the big level to watch. That's about 591 on the S&P. If you break below that, you want to be watching that 583, 584 level. We found support there after the Fed, December 18th and December 19th. Ultimately, bounce from that level the next day later, right, on December 20th, and now we're coming back down again. 100-day moving average is at 574. That, I think, is a good level to test, especially if big tech comes down, as I expect. But you may be seeing a broader market rally at that time because of the concentration in big tech starting to kind of dissipate a bit. And I've talked about this in many different videos now, so I don't want to stick on it for too long. But markets are in extremely fearful territory. Whether you look at the fear and greed index sitting at 34, which is, in the bottom quartile of fear. You're closer to being in extreme fear than you are to being neutral. That's pretty negative. And the percent of stocks trading above their 50-day moving average is at 35%. Anytime you've been in a bull market, which I think most people would say we're still in a bull market, you would want to be aggressively buying markets when 65% of stocks are in an active decline. When 65% of stocks are below their 50-day moving average, that is usually not when you want to be selling markets. That's when you want to be buying markets. Okay, so especially if things get worse from here, yeah, I think you really want to go into that weakness. And I know, as Warren Buffett said, the stock market is the only sale in town where people do not line up, okay? If toilet paper was half as expensive, yesterday than it is today, like if it went from $5 a pack or $10 a pack down to $5 or down to $2.50, people would go buy all of that, okay? It's not the case in markets. And, my goal here on this channel is to kind of help people, guide people's emotions during fearful times. Because, yes, sometimes there is a time to not buy, right? If there's a lot of weakness. The question is, did anything change? Did the economy change? Did the inflation outlook change? Did anything change? No, nothing changed with this latest drop. Yes, the Fed is going to be easing a little bit less than we expect next year. Maybe. It really depends how the data goes. So from that perspective, literally nothing changed at all. People are just very fearful and very negative. I want to be a buyer of that dip. Now, what's interesting about this week is Monday and Tuesday are the last days of 2024, and then Wednesday's closed for trading, and then Thursday and Friday are the first days of 2025, okay? So we get the end of 2024 and the start of 2025 all in 1 week. And I think the flip-flop could be quite pronounced, again, in some of the other areas of our markets, like small caps, industrials, cyclicals, right? As kind of that guy mentioned, you could see those areas start to do pretty well. Now, on Monday, we are going to get Chicago PMIs, pending home sales month over month and year over year, as well as Dallas Fed Manufacturing Index. On Tuesday, we will get S&P Case-Shiller home price month over month and year over year. Again, I think the last 2 days of 2024, Monday and Tuesday, are going to be a bit of a toss-up. Do we get some tax loss harvesters that start to buy back those stocks in anticipation of a better 2025, right? I think the selling in the RSP is more tactical than anything else. Does that start to happen the last 2 days of 2024? Or do you see those last minute tax loss harvesters that come out and sell stocks? I think it's a bit of a toss-up. I think Thursday and Friday, after, again, markets are closed on Wednesday, is a little bit easier to see the bullish case. Okay, on Thursday, we have initial jobless claims expecting 223,000. Again, if that number's too high, that's negative. If the number's low, that's positive. S&P Global Manufacturing PMIs will come out for Canada, as well as final numbers for December for the US. And then on Friday, we have ISM Manufacturing PMIs expecting things might get better a little bit, go from 48.4 last month to 48.5 this month. But manufacturing's been in a bad place for a while, so whether it's really good or bad, I don't think it's going to move the needle all too much. Only 20% of our economy is manufacturing, 80% is services. So I don't really think that's a big catalyst either. Now, as far as earnings, we really don't have any earnings. Literally no earnings for this week. Earnings season does not kick off again until January 15th. I think the question is, do we get a little nervous around that time with earnings? Do we get a little bit nervous about the inauguration on January 20th? Honestly, I don't have the answer to that. I would like to say yes, but if we kind of pull forward some of that fear now, it's going to be hard for markets to get even more fearful than they are right now, right? It's like, it's kind of easy to go from markets being super optimistic to neutral. It's a little bit, it's kind of easy for markets to go from neutral to fear. But when you're already at a fearful level, it's like, how much, I know this is not the proper way to say this, but how much more fear can, really come into markets without anything dramatically changing? That's the key. Nothing really dramatically changed, okay? From this bounce we got, from the Friday sell-off, nothing changed on Friday. Okay, 10-year treasury yields were up 5 basis points. People are scared about aliens, blah, 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 blah. But nothing actually changed. And I think that does set up an opportunity heading into 2025. Now, some people also point out the bearish divergence, the weakness on the RSI, which I guess is fair. People especially point this out on the weekly candlestick chart, where there's definitely this weakness on the RSI. And on the monthly chart, you could definitely see a little bit of a divergence there, although it kind of broke and looks a little bit better now than it did previously, because you actually broke to the upside. So I think this doesn't hold as much precedence now as it maybe did previously. So I think bull market's intact. I think you want to be buying any weakness we get here. I think you will be rewarded for that. The only place I don't like buying right now is big tech, because I don't think big tech's going to have the same kind of outperformance next year that it did in 2024 and in 2023. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.